You flip real estate, or are you selling a property and you want to make sure you can protect yourself from the buyer coming back against and suing you at a later date? Well, then you're going to want to watch this video because I'm going to show you exactly how to do that. All right, let's get started. Okay, so here's what I'm getting at now. Let's say you flip property or you're selling a rental property and you're concerned about a potential creditor coming back against you. And that creditor could be the buyer of your property. Maybe it's someone else you don't even know about that did some work on your property. So these are unknown claims is what I'm referring to here. And the concern that you have is that when you shut down an LLC, if you go through the proper steps, and on my channel, I'll put a link in the show notes to a video I put in place on how to dissolve out a limited liability company. But if you go through those steps and you close down your LLC the right way, then in many states, a whole lot of them actually, if that LLC is sued, and then when I say that LLC, if that dissolved LLC, so you filed articles of dissolutions with the state, maybe it's even Wyoming, by the way. If you've dissolved that LLC and then there's a creditor out there, unknown to you, and they decide to bring a claim at a later date, if that claim is not barred by the statute of limitations, so let's assume that somebody who bought a property that you sold to them is now disgruntled with the fact that this property does not meet their expectations. Maybe they didn't do a good home inspection because they wanted to just close on it really quick because it was one of those deals where they were afraid they're going to lose it. But now they're finding some problems that they should have discovered with their home inspection. So now they want to sue you for failure to disclose. Well, under most statutes, and I'm talking every state that I've been looking at that runs the exact same way, it states, meaning here's what the statute reads, that a creditor of an LLC that's been dissolved can sue that LLC for up to 3 years. And if there are no assets available from that dissolved LLC, because of course you've dissolved it and you shut the bank account down and taken the assets out, then they can go after the member of the LLC to recoup those assets. Okay, now, knowing that, then we need to create a structure to make sure that we are protecting ourselves against those types of claims. And I've had some real estate investors get sued by buyers of their homes a year later, up to 2 years later, and they rely upon the language of the statute. So what am I referring to then as far as how do you go about protecting yourself? Well, here's the way it works. If you're a flipper, then you'll know that our general strategy is this. You want to create an entity down here. Typically, it's going to be an LLC, and it's going to be treated as a corporation for tax purposes, for tax reasons. Now, that entity, the flipping entity is how I refer to it. It never holds title to property. And what you'll find is you'll have LLCs up here that will hold title to the property. And so let's assume that this flip LLC right here was created in Texas. Now that LLC is owned by your flipping company. So when you're flipping when you flip the property, you sell the property out of this LLC and the property is no longer held in a limited liability company. And then you shut down the LLC. Well, the buyer here of your home, they have 3 years to bring a claim against this LLC. Well, how do you sue an LLC that's dissolved? All you have to do is serve it on the Secretary of State. Okay, that, hey, I'm suing this LLC that's been dissolved. This constitutes notice, so then they can move forwards with their cause of action. If they sue the LLC, then they're able to go after the beneficiary of that limited liability company to collect any distributions it received in liquidation. Meaning that if I sold the house and I brought in $80,000 profit and then I distributed it to this LLC, they could go after this corporation for that $80K. Okay, so what is the problem there? Well, it's the state statute. Wyoming statute reads the same way. Nevada reads something similar. Delaware, Alaska, New Mexico, a lot of the states that we talk about from an asset protection standpoint that work great for anonymity and outside creditors, they're not necessarily your friend when it comes to flipping real estate or selling property because of these types of claims, because the statute is really clear. It states that they can come after your company for up to 3 years. Some it's 2, others it's typically 3. Now, how do you protect against that? Well, I have 2 strategies now that I am starting to use in order to help real estate investors who are concerned about this protect their assets. Strategy number 1. Okay, so this is the first option you have. is to create a blocker entity here. Okay, so create a blocker entity in Wyoming. Create a blocker LLC and have the red boxes, your property holding LLCs, all flow into your blocker entity, and then your blocker entity goes in to the corporation. Now, why am I using that blocker entity? Well, there's two benefits that come from the blocker entity. Number one is anonymity. Okay, so what do I mean by anonymity? Well, if somebody looks at my flipping entity, this entity right here, and they want to know who's involved with it, well, it points them to the Wyoming LLC. So just like all the strategies we talk about with Wyoming and using rental properties, it points them to Wyoming, and Wyoming doesn't disclose any information. So this gives us anonymity here, and it gives us anonymity here. So a buyer of a property would not necessarily know about this company or even me sitting down here as the owner and president of that organization. So that's one main benefit. Now, the second benefit is going to be asset protection. Okay, and I'll show you how this works here. Okay, so how do I get the asset protection? So you have flipped a property, you've sold a property, whatever it is, rental property, you've sold it, it's gone, it's no longer in your portfolio. You sold it to this buyer over here. They now own the property. And this was actually a situation I dealt with not too long ago with one of our clients. She flipped a property in New York, sold it to two attorneys. I mean, that's crazy, right? I tell people the golden rule of real estate is never lease to an attorney or sell to an attorney. Because if they have an opportunity, they're going to turn around and sue you if given the opportunity. But anyways, so after she did that, she then dissolved the LLC, filed the paperwork. We actually, filed this paperwork dissolving out that limited liability company. Now, this person turned around and sued the dissolved LLC. They sued the dissolved LLC, bringing a claim against it. Now, if they're successful in that claim against the dissolved LLC, and then they can go after the member of the LLC to try to seek payment. Now, here's why you don't want that orange box there, because they'll just go to the orange box. But by using a blue box, a Wyoming blocker entity, if they're able to figure out who the member is or where to go to get them, because when we file it, we don't necessarily tell them it's a Wyoming entity, but let's assume that they did. Well, that $80,000 I made on the sale came into my blocker entity. Then my blocker entity took a distribution to my flipping, what we call our flipping corporation, the LLC taxed as a corp. So it distributed the money right out. So at any given time, that blocker entity there, it's not holding cash. It's not holding something a creditor can take from it. The creditor's not going to be able to take the LLCs. You can't get those because we have charge owner protection. So those are protected. So they can't get after those. They're going to be going after the cash accounts, looking for money that they're able to claim that would be owed to them from this blocker entity. And if that really happened, going forwards, what I would do is I would create a new blocker entity over here that gives me anonymity, and I would start all my future flips going through this entity back down to here. But the point is that now you've prevented them from getting into this corporation by using a blocker entity. So if you want to make sure that if there is a creditor out there that you don't know about, after you dissolve your LLC, you don't want to be looking over your shoulder for 3 years going, man, am I going to get sued here because of something they may have discovered? Hey, use a blocker entity. That's going to give you some peace of mind. Now, if you don't want to use a blocker entity, here's another strategy you might want to consider. So these red boxes here that we're flipping through, and I don't care where you're flipping, this is what I would suggest you do. If you want to, if the anonymity side and the blocker entity is not that important to you, or if you could still use the blocker, it's not relevant. Either way, this works really well. You set up your red boxes here, these flipping entities. You set up Washington LLCs. Washington LLCs. Now you're probably going, Clint, why are you recommending Washington LLCs? Is it because you live in Washington? No. You see, there are reasons why we choose Wyoming to create that blue box. It has to do with its charging order protections, because the Wyoming statute is written in a way that provides us the protections we need. Hey, if I want asset protection, if I want anonymity, I'm going to Wyoming, possibly Delaware. Well, if I'm a flipper and I want to ensure that when I flip my property and I've shut my limited liability company down and I've dissolved it with the Secretary of State, I don't want a creditor coming back against me for up to 2 years and going after my assets. Okay, so here's Washington statute, and I'm going to show you the language which I feel is very important, which gives us added protections that you just don't get in other states. So what am I getting at here? So right away, when you look at the statute of Washington, it says, hey, if you don't bring a claim, it's forever barred. And if you want to bring a claim, it's got to be commenced within 3 years. Now that's consistent, like I said, with the other statutes. Washington takes the same approach that if you're going to bring a claim against a dissolved LLC, you have to do it in 3 years. But here's where it differs. So down here, there's no mention about distributions to members of a limited liability company, and that if you sue the LLC that's been dissolved, you're able to go after those distributions. Now, it does talk about, oh, you can sue a manager or a member if you have some claim against them, which makes sense. If a manager committed some tort before the dissolution of the LLC, yes, that claim would still survive. But it does not state that you're able to go past the LLC and recoup the monies that were taken out of that LLC in the dissolution. And to help you understand this, I want to show you the Wyoming statute. So it states this: a claim is not barred again under this section and may be enforced against a dissolved limited liability company to the extent of its undistributed assets. All right, well, that makes sense. If you keep a bank account open in the dissolved LLC name, they could go after that. But that's not what we're doing. We're shutting our LLCs down, or we're taking the money out. The problem is in the second paragraph, that the assets of the company, if they've been distributed after dissolution, it's still enforceable against a member or transferee to the extent of that person's proportionate share of the claim or of the assets distributed to the member. Okay, take it out of the legalese. What does that mean? Clawback. So if you took $80,000 out of your LLC in dissolution because you sold that property like we're talking about down here, if this was a Wyoming LLC or a Texas LLC or another state's LLC, you sold it and you put $80K down to here, they sue this and you left that money there, they could go and they could grab it. Washington state does not allow that. Washington state lets you bring the claim here, you can still sue it. So if the company has a bank account and has assets available, great, those are still can be attached, but you can't go down to the members. That's why I said, if you're flipping or you're selling property and you want those claims to stay barred, you got two strategies. You can use this Wyoming blocker entity, which is one way to do it. But I think the best way to set up my structure, if I was flipping, I would be using a Washington limited liability company. I don't care where I'm flipping, what state it's in. Flip the property through that Washington LLC. Probably have the blocker there for the anonymity, so it all flows like this, and then it's held by my flipping corp. You know, the way state statutes are written, I think is really important. We have to understand those laws and ensuring that we're using them to our advantage. In some states, probably not even knowingly, like Washington, has created a statute that allows people who sell properties out of LLCs to get some added protection that they're not going to be able to pick up in other states. Hey, if you like the video, be sure to hit the like button. If you flip real estate and you want to learn how to set up this type of structure for yourself, check out the show notes. I've got a link in there to set up a free strategy session so we can work on creating your flipping structure. Take care.